Hey, it's Chris Kirkpatrick with Life 180, and I've been having a lot of conversations with people about what's going on with the economy, where are we going with the economy, how do I prepare for the impending downturn, and so I want to do this video, and really the purpose of this video is to talk about all the different things and the different ways you need to structure your financial life to be able to be successful in every economic environment. I'm a big believer that if you want to be successful in life, you got to be able to identify the people who you classify as successful, the people that have the life that you want to live, that live not just financially, but they have the time freedom, they have the family life, they have the just ultimately whatever it is. I probably have a bit of a different definition of what it means for me to be successful than you probably have for yourself. And so I'm not here to push my values on anybody on what I think you should be considering successful. I simply want to encourage you to think about being successful and really taking a step back and identifying what that looks like to you. Now, one of the things that I also know is that you don't get to the top 5% of results in this world by implementing strategies that 95% of the world are implementing. Because if you look at the results in the world, you're talking about 92% of Americans right now are not going to be able to retire and maintain their standard of living. That is a disgusting statistic. That is the reality of the world that we live in. Now, when you talk about people like Dave Ramsey and Susie Orman, now I'm not here to hate on them, even though I disagree with a lot of the things that they do. What I will say about Dave Ramsey is he's really good at helping people eliminate debt, right? That is his strength. Where I have a challenge with Dave Ramsey is when it comes to the wealth creation stage and when people do get through the debt. And I have some differences on the debt as well, and I'll talk about that. But for the most part, I agree with everything, with most of what he says when it comes to debt elimination. The challenge is when it comes to the next stage is the wealth creation element of everything, and that's my challenge. Now, what I will say this as well is I said, if you want to be successful, if you want to be in the top 5% of the people, you have to go and find the people that you find successful in that segment of the population, in the top 5%, figure out what they are doing and emulate it, right? That's straight up. You need to go do that and you need to emulate it. That's one of my biggest challenges with Dave is he doesn't necessarily follow his own advice. He's really good at giving that advice, but he didn't create his wealth by doing that. And so he's not a product of his own product, so to speak, right? He is giving advice in a way that, quite frankly, it's not how he got to where he is. Now, if you are interested in just living a mediocre life and just kind of being middle class forever, and you're happy with that, no judgment whatsoever, then awesome. His advice is not going to hurt you. But if you want to truly get in the top 5% of the population from a wealth creation perspective, and you want to be able to create more and have a bigger legacy and be able to, leave your family better off than you came into this world and really push things forward, you're going to really, I think, struggle following that advice. It's not going to help you get to where you want to go as predictably as what I'm talking about. So now this is what I do here. Now I created this thing, I call it the Life 180 Pyramid, right? And so the Life 180 Pyramid, it's a simple concept here. If you talk to any CFP, they have to go and they have to learn the financial pyramid. That's what this diagram on the left side of the screen here represents. And so the concept of the financial pyramid is you need to build your financial life the same way you would build a pyramid from the bottom up. Now, the bottom part of this pyramid, this portion right here, the idea of this section of the pyramid, it's the foundation of your building. It's kind of like you don't build a castle built on sand. You have to pour the foundation first. Now, the foundation is your insurances, your safe money, your savings, stuff of that nature. And you need to make sure that you are solidified in your security there. You need to have a rainy day fund. You need to have cash for opportunity. All those different things. You need to make sure that you are solid, that your financial foundation is solid. And now, of course, there's more to it. There's also like a sub foundation because realistically, most people in this world have a lot of debt. right? And if you have a lot of debt, before you can even worry about that, you need to worry about wiping this out. So this is where Dave Ramsey and Susie Orman are quite frankly really, really good. Now, when it comes to the next stages of actually building the financial pyramid, that's where it starts to kind of all fall behind. Once you have your safe money built up right here, now you can start building up your medium risk. Now, what are the medium risk financial products? Now, those are any kind of investment or any kind of vehicle that you're going to use with your money that is more of a medium term risk. Something that you won't need access to your money for maybe 5 to 10 years on the horizon. And then ultimately the high risk, that's your long-term investment stuff, right? That is stuff, those are investments in vehicles that you won't need for, let's just say, the 15 to 20 years. This is 5 to 10 years, and this is immediate, right? So that's kind of the time horizon. Now, here's the challenge. And realistically, this is where about 5% of people follow this strategy, right? This is the way that most people in this country, in the United States, build their financial life. And why do they do this? I'm a big fan of asking the question, why? And they go through and they look at safe money, medium money, and then high risk, right? Now, I'm going to get into this. But let's talk about why this is the case. Well, think about it this way. Most people take advice from financial advisors. Most financial advisors, while CFPs have to go out there, certified financial planners have to learn, this pyramid here, essentially. Most Americans are structured, 95% of Americans have their life structured like the pyramid on the right. Now, what does that mean? Well, that means that for most Americans, your financial security is based on this one little point right here of instability, right? Because the National Institute for Retirement Income did a study, and it showed that 64% of Americans have less than $2,000 available to them if they need it. So what does that mean? That means 36% of Americans do have access to $2,000 or more in case of emergency or opportunity or whatever that comes to them. Here's the problem with that number is that 70% that said they had it comes from the 401k. Now, the problem with the 401k is that it's sitting in high risk, typically mutual fund type investments, right? And it sits down here in the high risk model. That's where most people's quote unquote savings are. People don't have savings in safe accounts like we're talking about in the left pyramid. They have their checking account and then they save for retirement. But this retirement, and you'll understand this as I go, winds up being their emergency fund to a certain extent, whether it's through loans or whether they lose their job and they need to liquidate it, because this is what happens, right? This is what's falsely taught. Now, let's talk about this for a second, because this is the way that the world kind of happens around us, right? So the market is not linear, it's cyclical, right? So we don't just kind of have this slow upward track that you see on all the charts of all the mutual funds saying you're going to get an 8% rate of return over, every year in, year out. That's not what happens, right? What happens in truth is that the market goes up and it comes down. It goes up, it comes down. It goes up, it comes down. And you'll notice that while it takes 8 to 12 years to go up, it takes 1 to 2 years or maybe even just 6 months to go down, right? And it happens violently. Now, once again, if you want 5% results and you can't go do what the other 95% of the people are doing, the challenge is most people are focused on this period of time and trying to make money when everybody's making money, and they're so short-sighted, and we don't realize, or most people don't think about that the market is cyclical and it's going to crash. And this area right here is where the most opportunity is. That there's no way around it. Now, here's why people struggle, right? Is because while Main Street America, what happens, actually, let me come back here. What happens is when you are in a situation and you lose your job, or the economy tanks, let's say that's the first thing that happens. Well, then what happens is, when that happens, you probably need money. The average time to find a job is about 9 months to find a job. And then when you're looking for a job, typically because you don't have savings, your 401k is your savings vehicle. Well, once again, I'm not saying a 401k is bad. I'm just saying understand what the 401k does for you. Now, when you're dealing with your 401k, this is so important to understand that last year, $7 billion in taxes, I'm sorry, no, 7 billion, my bad. I wish it were only 7 billion in taxes. $7 billion in penalty were paid. And guess what? 14 billion in taxes were paid. So people paid last year 21 billion in taxes and penalty, right? 21 billion in taxes and penalty just to access their money. Now, what happens? Let's talk about what that looks like for your financial life if you are in fact following that model. And this is what most people, whether it's in a qualified plan like a 401k, whether it's in an IRA, whether it's in a simple, whether it's in anything of this nature, it's qualified money. So you put it in, you think you're getting a tax break. Really, you're just getting a tax deferral. You're not getting a tax break, and that's a key distinction to understand. And so what happens is you lose your job, right? And so you have to take money in a negative environment, so a negatively performing asset, because the economy went down, you lost your job, so probably your asset prices, your 401k portfolio is worth less than it was before. So now what do you have to do? You have to liquidate money out of a declining, negatively performing asset, which is absolutely the worst thing you can do. You're going to wind up paying taxes and penalty on that money. That crumbles your financial pyramid, and you start from scratch right at the beginning, right? So you worked in that scenario, you worked these 8 to 12 years here, right? These 8 to 12 years, you built up because you didn't follow the pyramid on the left, you followed the pyramid on the right. You have your money in high risk, you have very little safe money, very little money, and you feel good because maybe you got $50,000, $60,000 sitting in high risk event or high risk account. But here's what happens. Then the market tanks, right? It goes down right here, right? And while the market may start back up right here, right? That may be the case. The market starts back there. But what happens is you start right here because you took all this time. And the difference, the gap here is taxes, penalties, interest, and just bad decisions, right? So like those things have a seriously negative impact on you. Now, if you are 25 years old or 30 years old right now, you have 3 cycles like this during your career to be able to get retirement and to be able to have the results that you want in life. And that's why I kind of show 3 cycles here. If you have one of these cycles like this, it makes your ability to have a successful retirement and reach your goal here at the end when you're 65 years old. And you've reduced your ability. I don't know the numbers, but I can tell you it's extremely significant in how it's going to have a negative impact on your ability to reach your goals. Now, remember, people feel during this period of time when everybody is doing well and things are going up that you're doing well. You look at your account, you have money, it's growing, things feel good. You take on more debt, you buy nicer cars, you increase the size of your house. And they lose sight of this concept that you cannot spend paper profits, and it is what it is. Like it leads to the downside. Now, this and I'm going to erase this segment of it down here because I want to talk a little bit more in depth about what I would suggest. I don't want to throw just all negative stuff at you here for all this because it is what it is. There's a lot of ways to handle this. This is the purpose of what I want you to take out of this video is I want to show you a simple predictable way essentially that you can kind of build a tunnel going from what everybody else does to putting yourself in the 5% and building your financial life and structure the way that the most successful people in the world do, right? I mean, that's the reality. Because remember, economic storms are going to happen. They're just going to happen. There's no way around it. So you can either try to make money during this 8 to 12 year period when everybody else is trying to make money, or you can make money during this 1 to 2 year period when most people have what I call Chicken Little syndrome and they're heading for the hills, right? And they're scared and they don't know what they're going to do. They're making bad decisions. They're having to make bad decisions with their assets. They have no cash. And what happens, if you think about it, when the sky is falling, so to speak, in down economic environments, the opportunity, can't talk and write apparently, for the people in this side of the pyramid, right there, that opportunity goes down for them, and the opportunity for these guys goes up, right? So like that is the key thing. You want to make sure that if you want to make money, and this is the thing that I have in conversations with people. I don't want to get into politics or anything of that nature with anybody, but this is a key thing to understand. I think anybody that says that there's not a growing gap between the wealthy and the middle class is delusional, because it's absolutely happening. But what I'm showing you right here is the exact reason, because the wealthy, every economic disaster creates opportunity if you are structured properly for it. More millionaires were created in 2009 than ever before, right? So think about that. That was a time of complete crisis, or coming out of a complete crisis. And the reason it happened is because more people, were structured like this and they were ready for it, right? So that's the thing, that you need to understand is if you can set yourself up for that, you can have massive results in very short periods of time. One of my main mentors actually did this with real estate, and he said in 2007 he went out and he kept all his money in safe, liquid accounts that he could control, that he could invest in things that he understood. He had a lot of money sitting in these safe accounts. Why? Because he didn't want it in the high-risk accounts like everybody else, because in 2007, when everybody was making bad decisions, he lived in Florida in the Tampa Bay area, and he went out and he bought 4 houses for between $65,000 and $80,000 a piece. Right? They were in foreclosures. And when you're trying to buy houses at 65 to 80K, you're talking about there's no leverage. You cannot get a loan. There's nothing of that nature that you can go do. You need to have the money completely liquid. Access to capital is king in that situation, right? So when that happened, and that was 2007, right? So in 2011, he then flipped those houses and sold them between 360 to 380, right? So we ended up making about 300K per property times 4 equals 1.2 mil, right? So I don't know about you, but he, during this 8 to 12 year period, you're actually, from then it was 2001 to 2007, so it was really only a 6 year period for him. Everybody else around him, when the market was screaming up and the real estate market was booming and he saw things a little differently and saw an opportunity, and he kept his money safe. He didn't worry about doing this whole game and playing the game like everybody else. He simply wanted to focus on, building his safety and doing that. But then in about a 4 year period, he ended up profiting 1.2 million off of that. Now, he was an entrepreneur. He had money in his businesses and all that stuff as well. But that is a huge thing to understand. So why is it if this concept is so amazing, right? Why is it you've never heard about it? Why is it that, most people are being sold this line of garbage, in my opinion? Well, it's because, like I said, financial advisors are not really financial advisors for the most part. Even fiduciaries, they're supposed to give you advice that is in alignment with your best interest. But here's what I'm going to tell you about this is that when you talk about FINRA and the SEC, those regulations are really designed to to not protect you, the consumer, but to keep the advisors out of trouble, so to speak. Trust me, I came from that world, and that is a fact as far as everything goes. I was in charge of recruiting and development. I brought agents on. I taught them how to build their practices, and I tell you, regulatorily speaking, that is a huge thing. The SEC and FINRA, they do not exist for you, the consumer. They exist to protect the advisors and to make sure that they toe a certain line. Now, they like to pitch it from an angle that it protects you, the consumer, and there's an element of truth to it. However, a little side note here to consider is that when you talk about fiduciaries, you're talking about paying a percentage of whatever money that you have to them every year for managing their money. Now, it's sold to you on the idea of like, hey, listen, we're done with commissions. I'm not going to charge you a commission to buy a mutual fund. I'm not going to charge you a commission for a trade for a stock. We're going to be charging you a percentage based on assets that we manage, right? That's why all advisors right now focus on what they call AUM, assets under management, right? So if that's the case, they are taking usually between a 1% and 2% managed money fee, right? So if they're taking a 1% to 2%, that means if the stock market does 6% and you're paying a 2% managed money fee, you're only netting 4%. This managed money fee is the greatest erosion of your wealth potential outside of taxes than over anything else that exists in the world. So one of the things that I would really encourage you to consider and research and really think deeply about is this conversation. Now, I'm not going to go super deep into that, but I think that's a really important side note to really consider and understand if you are thinking about how to structure your financial life. And it just kind of is icing on the cake on top of the nightmare that is this. I think that it's been created to give more stability in a tough business that is a sales business of being a financial advisor. Doing that creates more stability and financial stability for the advisor, not you, because they get paid. Even if the market goes down, it turns a 10% negative year into a 12% negative year, right? So remember, if you lose 10%, you got to make 20% pretty much just to get back to even. If you lose 50% in your retirement account, you need to earn 100% just to get back to even. So that's really important to understand. Now, here's what I want to say. I'm gonna stop with my rant. I hope you understand that what I'm saying. I hope you're looking at this and it makes sense and you realize that, wow, I can do this. What I would encourage you to do, here are my rules. Here are my rules for people when it comes to their finances. A, you need to make sure that if you look over here, that this area, this box, this foundation of your financial pyramid is built up properly. Now, what does that mean? That means you got to have the right auto insurances and just insurance protection in general. You need to have disability insurance. Long-term care needs to be set up. People think about life insurance. I'm a big believer in life insurance and actually leveraging life insurance in ways that most people don't think about. Now, here's the one thing I want to say, though, is that this is a big one that's missed. You're 70% more likely to become disabled before you turn 65 than you are to die. Yet everybody buys life insurance and very few people buy disability insurance. So those are really important. Now, what you probably care about a little more is cash savings, right? So when I talk about savings, I talk about having 2 years income, right? Now, why? Because I want you to have 1 year for emergency, and I want you to have 1 year for opportunity. Now, I know this sounds like a big number. I know it's really overwhelming for a lot of people when they think about that. But if you make $50,000 a year, right, that means you got to have $50,000 in an emergency fund. Why? Because if you look at the average time it takes to find a job when you're out of work, it's about 9 months. Now, during a down economy, that can get even worse, right? So I want you to not have to make any desperate bad decisions. The way you're going to get wealthy is to do things differently than other people and to structure your life accordingly, right? That is what makes people wealthy, is this moment, this opportunity right there, right? So now the 1 year for opportunity, that is also obviously, so when the opportunity in this moment arises, you can take a shot at that opportunity without also being super risky. Now, that's why I say that. Now, the vehicles that you want to use, if you are looking to say, okay, this makes sense, I'm curious, I'm interested, what I would encourage you to do is I have a link. Click the link below. I'll just write it out here. So click the link below in the video here, in the YouTube link. If you look in the description, there will be a link down there that you can click on that will bring you to a page that you can set up an appointment. Now, I work with a guy named Caleb Williams. He owns a company called Better Wealth Solutions. He and I have partnered on a lot of this stuff. I'm going to be fully transparent with you. I used to be a life insurance salesperson, so to speak. My job was I was a head of recruiting and development for a Fortune 1000 life insurance company and broker dealer. I was all securities licensed. I had everything. I could do it all. I could help people in every way buy pretty much any financial product that you would want under the sun. However, I decided that I didn't want to be in that world anymore because it just, there was too many conflicts of interest. And what I did was I wanted to focus on more of the education, and that's why I started Life 180. Now, the reason I partnered with Caleb is because he's one of the few people in the world that I trust to do this right. So if you are looking at this and it makes sense, he's one of the few people that I know that I could just hand you off to, that you could talk. Not that I'm not willing to be part of the conversation, because I absolutely am. Caleb and I work extremely closely together. He is my personal agent. He's my personal advisor that I work with. And he and I trust him implicitly. You're not going to find another person on the face of the earth that is going to care more about helping you get to where you want to go than Caleb or I. I promise you that. Now, if this makes sense, just click on the link below. It'll bring you to a page, and on that page will be actually a link. You can opt in. You can take a look at the link, and you can set up a time to have a conversation, a free introductory conversation where we can figure out, what does your financial picture look like? I mean, we don't know where you're starting from, right? We don't know, how much money you have. You may just be in a ton of debt down here, and you may need to get out. You may have good cash flow, and it doesn't matter your income. I've met people, that make $250,000 a year, right? And they're in worse position. Because they're so leveraged up and they have so much debt and so many toys, and they suffer worse during down economies if they don't have their life structured properly, because of the fact that if you accumulate all these liabilities and car payments and loans and all these things, when the economy goes down, they suffer more, right? Sorry for my handwriting. I know I don't have the best handwriting, but so that is important. So don't talk yourself out of it. What I would say is, if you think you resonate with what I'm saying and you're like, okay, listen, even if you like Dave Ramsey, here's what I want to say. If you like Dave Ramsey and you like his advice about this, I would really encourage you to stop at his debt elimination stuff and really think about, what is it going to take to build your financial pyramid in a most stable way that's going to help you get the success and the results that you want out of your life in the most predictable manner possible today. So anyway, I hope that makes sense. I hope you go out there and crush it, live abundantly, live efficiently, live life 180. Make sure to comment in the comments below if you have any questions. Also, if you like this video, if you found value from this video, we're going to be putting out a lot of content. Go ahead and click on the subscription button. Make sure you click the bell. That way, when I launch a comment, you are notified, and we will go from there. I look to talk to you on the next video, and hope you go out there. Have an amazing day. Take care.